All right. Let's get started. A couple minutes late, I got distracted by my portfolio. Was sitting here waiting for time to go by, and the next thing I know, time's gone by. All right, let's get rocking and rolling. Last night we had a wonderful class. This is the final class of the first introductory to the stock market, and we talked about what type of trader are you going to be, and then we also talked about the technical analysis, or just kind of an introduction to what is technical analysis. We started counting markets. We would do, three drive patterns. We learned about Elliott Wave, just a little drive one, a little pullback, drive two, higher highs and higher lows, lower highs and lower lows, right? Higher highs and higher lows makes an uptrend, lower highs and lower lows makes for a downtrend. And we learned about those types of things. I want to bring up the manual for the class. All right. So for those of you who are here and not part of the university class, welcome. I'd like to have everybody here, and lots of people are welcome. Anybody's welcome. We are on YouTube. But this is a class for my university students. All right. So that's why we kind of bounce around in this YouTube channel to different subjects, because it depends on what I'm teaching down at the university. And then, of course, when there's no classes at the university, we continue the labs. And so you can always come back, and we just kind of go through the process of trading and building our portfolios. And I have my portfolio that I like to share. I have, like I said, last night, I have about 7 trading accounts, but I have one that I share with the class. And we go ahead and look at real money trades, and we do a lot of that. And so it's a lot of fun to come and learn, even though you're not part of the university. And so everybody who's here who's not a part of the university, you're still welcome. And so what we do is we're going to go through, and this is the lab for the class that we had last night. And so we're going to talk about what we talked about last night. We're going to go through and we're going to practice what we preach. And we're just going to go look at a bunch of charts, and we're going to apply the knowledge that we had, or that we gained last night, to the markets that are actively trading right now. So I want to pull up the manual. So this is the manual to the class. And we are going to be working today on chapter, well, we don't go by chapters in the book. We go by rules. So we have 5 rules. So we have count, measure, setup, trigger, and follow through. What do we count? We count the waves, right? Higher highs and higher lows, lower highs and lower lows. How many times do we make those higher highs? How many times do we make those lower highs? Now, markets generally, typically speaking, when you're in a normal market, whatever a normal market is, when you're in a normal market, historically speaking, if you go back and look years and years and years and look at the probabilities, remember, everything about the stock market is about statistics and probabilities. And so that's what this trading stuff really is. It's a statistical class in probabilities of the stock market moving higher or lower. And so we always play the statistics. And so we never go all in and we never go all out, because we don't know whether the market's going to go up or down. But we have statistically high representation of price when it makes a specific pattern or a specific move in the market. Of those statistics get higher and higher, probabilities that get higher and higher, that the market's going to either rise or fall. And so we add a little bit. If it goes a little more, we'll add a little bit more. If it goes a little bit, we'll add a little bit more. And then we dollar cost average. We dollar cost average in, we dollar cost average out. Okay. And generally, I like to dollar cost average in on the way down and dollar cost average in out on the way up, so that we're not building upside down pyramids. And you know that I have that little chart up here too. Or at least I did just a minute ago. Here it is. So remember, the most important chart that I can show you, if you don't learn anything else in this entire semester, is this little picture right here. Do not build upside down pyramids. It's the fastest way that you're going to lose your money, and it's the number one way that retail traders trade. This is how retail traders trade, and it's why 80% of retail traders lose money in this industry. All right, it's because you build upside down pyramids. They're dangerous. What is an upside down pyramid? For some of you who weren't in class last night, an upside down pyramid is when you start to buy low with a small amount, and as the market begins to go up a trend, you start to buy more and more and more and more and more. So what you're doing is you're building a pyramid, only you're building an upside down pyramid. So your dollar cost average keeps climbing and climbing and climbing and climbing, and your average entry price goes up and up and up and up as you keep adding to your upside potential. And then what happens is, if the market, all it has to do is just fall a little tiny bit, and your average price is now underwater and you're losing money. And so if the market keeps coming down, 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 well, you've lost, and now you lost more and more and more and more. And you're like, I'm going to just hang on until it comes back. Well, markets can stay irrational longer than you can stay liquid. And that market just keeps coming down and down and down. And after a while, you've lost so much money, you just bail out. And then that's how you lose all your money. All right. So don't build upside down pyramids. What we do is when markets come down, that's called buying high and selling higher. That's the buy high, sell high strategy. It's really hard. Doesn't mean you can't do it. There's people who do it and they like to trade that way. It's just a really hard way of trading. All right. So I like the other strategy. I like this one here. I like the strategy where we buy low and sell high. So when markets are coming down, that's where we start to buy in, right? Now, we don't know how far a market's going to come down, but we do have mathematical models that can help us. And if you stick with me and you go through some more of these classes, I'm going to teach you all that stuff. We have what we call the delta cone of probability. We have Fibonacci rulers that measure those projections and retracements. And we have ways of calculating when markets are overbought and oversold, and in locations where it's probably a good idea to start adding on to your positions. So we buy as the market's coming down into these high probability locations, and we buy our positions, buy. And now we have a nice, strong, wide base for our portfolio because we bought on the way down, not on the way up. Now when the market turns and starts to go up, we have this big, wide base, and then we can start to sell off as markets go higher. And we take profits along the way. I always say take profits along the way. And for those of you who are here and know anything about what we're going to be teaching, not in the, partially in the next class that starts next week. And then the following class after that, we have some funds that we like to build our portfolios around. And that's what we want to do. That's what those funds are really good at, is they build these portfolios. So we sell off as markets come up. That way, when we sell off, when markets come up, we get to the top of these very peaky high positions, and inevitably the market's going to give back some, and it's going to come down. At that point, well, we don't have any shares left. We sold out. We buy low and we sell out. So we buy on the way down and we sell on the way up. And it's just the opposite of what retail traders do. Retail traders, they sell on the way down and they buy on the way up, and that's why they lose money. All right. It's a hard thing to do. You have to kind of change your brain. And I told you in class, that's one of the things that we're going to do in these classes. We're going to change your brain, change your mind, make you start thinking a different way. But it's not anything you haven't heard. Buy low, sell high. It's just that nobody does it. They start buying low down here with one or two, and then they keep buying as the market goes up. And that's what causes their grief at the end. When the market gets to the top, they got a huge position up there, and the market only has to fall a tiny little bit, and you lose all your money, because that's where your average entry price is. Right? Because you add all the prices together, divide them by the number of shares you have, and that's going to be the average of your entry price. So it's better to do it with the upside right pyramid, which is buy low and sell high. All right. So that's how we do it. Now, if you're smart enough to build your portfolio like this, and it starts to build this great big portfolio, and you get up there and then you sell it all at once up the very, very top, which nobody ever does, then sure, you can make a lot of money. All right. Because you got a big upside down portfolio. You got all your money sitting up here upside down. If you get rid of it all at once, boom, which is what we generally don't do, right? Don't just jump 100% out of the market. But if you're going to build portfolios like that, that's what you have to do. Because if you don't, and it goes just a tiny little fall, you lost everything. And markets like to make little tiny falls. And then they like to go back up again, which is what scares those types of traders. So don't be that guy. All right. Let's not do that. So back to our manual, what we're going to do is we're going to go through rules 3 and 4. So count, measure, set up, trigger, and follow through. That's our trading mantra, our trading strategy. Whenever you trade, you have to have a strategy. So count, measure, set up, trigger, follow through. What are we going to count? What we're going to count is we're going to count how many times the market goes up in those A, B, C, D patterns, right? ABC pattern meaning the higher highs and higher lows. How many times does it do that? Now, usually, traditionally speaking, historically speaking, we generally see 3 of those, 3 drives. Drive 1, drive 2, drive 3. All right. Now, it doesn't mean it can't go to 4, 5, 6, 7, 8, 9, 10. Certainly can, oftentimes does. And in the recent markets, since the Trump train is back going again, then it certainly has. It has done more than 3 drives. It's gone 4, 5, 6 drives. And sometimes they get a little skunky and it's kind of hard to see which ones are which, but we got tools that'll help us do that. And we're going to flip over here to the software in just a minute, and I'm going to show you the tools that we use to do that. So you remember last night you saw this picture. This is the how we draw trend lines. And so it's breaking of trend lines. Those are setups and triggers. So we count, we measure how big those moves are, right? So if we're going to count them, we need to measure them. So we have a ruler. It's called the Fibonacci ruler. That's the name of the book, the Fibonacci effect, right? Because it's based on measuring, projecting, and retracements of those trend lines and those trends. So we're going to spend our time counting and measuring. And so we have an idea. We're kind of give ourselves a visual picture of how the market's moving through price and time. Now, remember, it's you against the market. And I want you to think about the market as if there's only two people trading, you and one other guy on the other side of the market, and you're trying to take each other's money. All right. It's like playing football. Remember, I told you in class, we got two teams. And this team, they have plays that they run to move the ball down the field, make money. This team has plays that they run so that they don't lose money. They move their ball down the field going the other way, or to block you from going down the field. So there's always, like, think about it as two people, but really who you're trading against is you're not really trading against other retail traders. They're participants, but really who you're trading against is the large institutional traders, the big banks and hedge funds. Now, the advantage of trading against the big banks and hedge funds is that they have a tendency to do the same thing every time. All right. They're just kind of very rote. And in fact, they've pretty much programmed all of their trading strategies into a computer. And they don't really sit there. There's nobody sitting over at BlackRock or Vanguard pushing mouse buttons to trade. They don't do that. All right. They've got a big computer, and the big computer just watches the market, and it does things based on probabilities. It doesn't know you're even there. It doesn't even care about you. All it cares is that, oh, the market's doing this. I'm going to put some money in here. I'm going to put some more money in here. I'm going to put some more money in here. And what we're going to do is we're going to go through the accumulation distribution model. It's called the Wyckoff accumulation distribution model. So if you want to go and study a little bit more about that, we talked a little bit about it. We touched on it on class. Again, we're going to have another class here in the future in this semester where we're going to talk about that in greater detail. But if you want to start studying a little bit on the Wyckoff theory, you can go out to YouTube or out on Google, or use one of these AI systems and say, tell me everything you can about the accumulation distribution model. But basically what it is, it's how big banks and hedge funds trade. And how do they trade? Well, they trade like this. They trade these types of pyramids. All right. So that's what you're going to be doing. You're going to be learning how to trade like the big hedge funds, and you want to know what they do. And we want to kind of track them, and we want to follow them. And we say, okay, I can see what they're doing here, because they do the same thing over and over and over again. There's nothing secret about what they do. We know what they do, or at least I do. I know what they do. That's why I'm here to tell you. I'm going to teach you what they do. I was back in Chicago for 10 years. That's what they taught. All right. I know those were the guys that I sat in class with for 10 years back there, and I know what they taught them. So I know how they teach, and I know how I know how they trade. I was in the class with them. I came here and they went there. They trade in Wall Street. I came here. I am teaching you what they do. So we know what they do, and I'm going to teach you that. And it's the Wyckoff theory. Okay. Wyckoff accumulation distribution model is what they would teach back in Chicago when I was there. And that's what they would teach those guys how to trade. So you can go and study that. I'm going to help you here, and we're going to apply it to the markets here. So you can work with me, and I'll help you learn how to do that. So then we have reoccurring price patterns. So we count, we measure, we look for the setups. What's a setup? Well, a setup is a breaking of these trend lines that we talked about. And we talked about a lot of different setups, like all these little patterns, right? These little patterns here. I got a whole bunch of them in the manual. We talk about where they show up in the Elliott wave, where these patterns all show up. But these are some of the patterns that you see right here. They're all in your manual. And so this is the manual. And those of you who are not part of the university and you didn't get the manual, you can get the manual. It's online at Amazon. Just go out and search my name, Lan H. Turner. Make sure you put the H in there so my name shows up. So it's Lan H. Turner. And the cover of the book, let's go back up so you can see the cover of the book. The cover of the book looks like this. All right, let's see if we can make the whole cover on there at once. So that's the cover of the book. So that's the one you want. Make sure you get this one. And if you get a used one, I know one of our students in class said, well, hey, somebody's selling a used one. They got the used one, and then what they shipped them was the old one. They didn't get the new version. So make sure you get the new version. Probably want to just buy the new one so you don't get the old one if somebody's got a used one. And then you can have this book too. If you want the electronic version, which is $10 less money, you can go get that over at pitnews.com. Go to pitnews.com, pitnews.com, go into the store, slide down, and you can buy it for like $19. And it's the digital version. All right. All right. So we're going to count and we're going to measure and we're going to do setups. So what are we counting? We're counting the waves of the market, basically 2 A, B, C drives in a row, right? A, B, C, D, higher highs and higher lows. That's an Elliott wave. Then the market has a tendency to turn around and come back down half or 50% of the last major move, which is why we measure that. We want to measure how far half is, and that's called the delta cone of probability, all right? Because the market likes to stay within the delta cone of probability. And then we're going to come down, and we got fancy ways of counting it, and I'll show you all this stuff too, and it's in the manual. We're not going to get too deep into that. Again, we got another class coming up where we're going to get into this in greater detail. But this is coming down through here, and you can see that we're going to go in, and we got lots of little examples in the book, and we're going to go through, and we're going to go do this right now on the current market prices, all right? So we're going to go look at the reoccurring price patterns. We're going to look at all this neat stuff, and that's why we've got the charts pulled up right here. And I want to start off with the S&P 500. So we're going to come down here to the S&P, which is SPY. That's the S&P 500. That's what the S&P 500 biggest, best stocks in the entire world have been doing in the past year. Just going almost straight up, all right? Now, we're going to go through and we're going to decorate this thing up because it's really hard to trade off a chart that looks like that. But if you just go to any plain Jane trading platform or trading software or charting application out on the web, this is probably what you'll get. All right. You need to decorate it up. You need to put your Christmas dressings on it. All right. Make it look like a pretty Christmas tree so that we can actually trade it. So we're going to put all of our indicators on it, and I'm going to show you how to do that. So for those of you who have track and trade, this is how you do it. If you don't have track and trade, you're going to have to do a little translation. Okay. But a lot of packages have a lot of these same tools, but they do things a little bit differently. I think Track and Trade is the best program. This is the one I use. And so this one I would recommend if you want my help that you use so that I can help you. All right.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
The nice thing about trading with Track and Trade is it is your access to the brokerage firm. You're not using a charting application, and then over here you're having your brokerage access. You just do it all right through here. And to open your account, you come up here, you click this, you say open your account, and it brings you up to a little screen, which I'll pull over here onto the screen. And it's really easy. You fill it out just like you're filling out it's like opening a bank account. All right. Opening a trading account is very similar to opening up a bank account, and you're going to put money in there, and then it sits in cash. So it's not at risk. It's not going to go into the stock market. You put your money in there, you put a little bit of cash in there, and it just sits there. And then when you decide you want to put it into the stock market, you move it in and out of your cash account. And it's very simple. The way you do that is you come in here and in Track and Trade, you go to the trading tab, and there's your account. You can see this account. This is a demo account. They give you about $100,000 to play with. And you can see I've got 122,000. So in class so far this year, we've made about $22,000 in class, just playing around. So that's what that means. But that's where your money sits. It kind of sits over here, $120,000. And then this is the way your real money would be. If you gave them 10,000, it would sit over there in 10,000. And it's not at risk. It doesn't lose money. It doesn't make money until you actually put it into the market. So when you put it into the market, this is the S&P. It's very simple to put it into the market. If you come in here and you say, well, I want 25 shares of the S&P, you click that little 25, or maybe you want 26 shares. You can run it up and down one at a time here. And then you just hit buy market. And that's all there is to it. That's going to put you into the market. Now, the great thing about Track and Trade is that now you have this accounting system over here and down here. So you can see what your orders are. You can see what your open positions are. You can see what your closed positions are. You can see what your options chains are for those of you who trade options. And I got a class coming up for that too. And I'd highly recommend you get registered for that one. And we're going to show you how to trade options, which is really awesome and fun. And these are just a great tool. Can show you all your puts and your calls and your closed positions, open positions, all right here in one place. It's very simple, very easy, and you got all your drawing tools for all of your technical analysis and everything right here in one place. You don't have to go anywhere else. Everything's all in one. Okay. Now, there are some other places that we like to go when we're doing fundamental. This is very much a technical analysis trading tool. And so if we need fundamental information, we do go out on the web and we search for fundamental information. Now, fundamental information is kind of like news reports and weather and government reports and how much earnings and all that kind of stuff. All right. So that's not in the trading platform. Trading platform is all about technical analysis, setups, triggers, and decision points where you're going to get in. All right. So that's telling you right there. You can see on your line where that's at. Now, if that market moved and you started to buy here and then you kept buying, that green line would just keep going up and up and up and up. And what you're doing is you're building that upside down pyramid. But if you're doing it the other way and the market's coming down, and you buy all the way down, well, you're building an upside down or an upside right pyramid, and you're actually, that green line would be way down here. So when the market turned and started to go up, you wouldn't be losing money, right? You just kind of buy on the way down, and then it brings your average cost down. And then when the market turns and starts going back up again, which it inevitably has in the past, not going to say it will in the future. Nobody knows what the future brings, but in the past we have. Okay, so we're going to come in here and we're going to start setting this thing up. I'm going to show you the settings, and then we're going to go through and I'm going to show you some of the patterns. And then we're going to go and apply this to some other charts. We'll go look at some of the more fun charts that people like to trade, like Apple and Amazon, Netflix and Google, and we'll go look at some of those fun charts. We'll go look at silver and gold and see what they've been doing. Going crazy. All right. So for now, I'm just going to take this position off. I'm going to get out of the S&P. Well, why we've been sitting here, we just made $9 with the S&P. You can day trade if you want. That would be a day trade, right? We're up $10. I hit exit chart. We're out. We just made $10. There you go. No harm, no foul. So that's how you day trade. So we don't day trade, though. We're not going to day trade today, not in this class. We'll do day trading in another class. Again, I'm going to teach another class on day trading here coming up. But really, day trading is just, looking at a shorter term chart and then doing the exact same thing. If I didn't tell you this was a daily chart, you wouldn't know, because it looks exactly like a day chart. It looks like a 1 minute chart. So, you can trade the exact same strategy day trading and just do the same thing. It's just over a shorter period of time with a smaller amount of money, probably, maybe. Depends on how big's your account, right? And what you're going to do. So we're going to come in here, and the first thing I want to do is I want to change the price bars. Now, you all know, because we talked in class, that this is an open, high, low, close bar. Open, high, low, close, meaning that each one of these little bars represents one day, because it says up there in the left-hand corner, daily. And so what we're going to see up there is, let me bring this back. Okay, so what we're going to be seeing up there, there we are. Okay, so what we're going to be seeing up here is each day's representation represented in a price. So this is your price chart along the right-hand side. You can see 650, 675, 700. You can track and trade. You right-click on the chart. You could do so many things on the right-click menu and track and trade. Make sure you right-click on everything. Everything's got little right-click menus, all right? You can do little right-click things on almost all the buttons. There's things that you can right-click on. So right-click on stuff so that you get the right-click buttons, okay, the right-click charts. And then this one's the big main right-click chart. You just click on the chart with the right button on your mouse, and then you come down here to chart preferences, and there's all kinds of things in here you can change. Now, one of the things about track and trade, the reason this control panel is over here on the right-hand side and it doesn't pop boxes up in front of you is because this is an active trader platform. So you're actively trading and then changing things over here in the window. And if every time you want to change something, it pops up in front of the chart, well, that's really frustrating to have your chart covered up and you can't see it. And you're over here trying to make changes to your chart or to your indicators or something. So everything is done on the left-hand side. It's over in this little panel, so it doesn't cover up the chart. Now, unfortunately, we are trading on a platform that's called Windows. All right. And so Windows has Microsoft, because it is a Microsoft Windows package. Sometimes they do force Windows to pop up. So there are occasions where when you click on something, a little window does pop up in front of the screen, but that's because we have to. We don't have much of a choice. Windows forces us to do some things like that too. So you do get some windows popping up, but where we can, we try to eliminate that as much as possible and put them over here in the left-hand control or in the right-hand control window. And when we do that, well, sometimes they get it seems a little bit overwhelming. But if you just kind of read down through it, it's really quite simple. It's just kind of like a little menu system, and you just go through and pick your tabs and the things that you want. And they're pretty much self-explanatory. If you don't know what they are, call the tech support number or click on them and see what they do. You're not going to hurt the software. You can always hit the button that says, up here in the help menu that says restore, reset all questions, revert to factory settings. You can set this thing all back to where it was. Or a lot of these tools just say, right here, my defaults or TNT defaults. If you hit the TNT default button, it It puts it right back to the way it was. So you can go in here, change it all up, do whatever you want, and then you can save it as my default. Say, oh, I really like that. You can save it, and then it'll always be like that. Or you can just say, oh, I'll go back to TNT defaults and I'll start over. So you can't really screw it up, and you can always get back. Okay, so we're going to come down here, and one of the things I like to do is I like to turn on that Fibonacci bars. Now, there's two ways to do that. If you come over here, you right-click, and you come down to Chart Preferences, it brings up this control panel right here, the Preferences window, and right there you can see where it says Fibonacci. Now, you can also see where you can change the defaults. Do you want your defaults to be open, high, low, close bars, close bars, open bars, candlestick bars, or no bars at all if you just want lines, all right? So you can do that. So you can come in here and make any kind of chart you want. I would recommend you come in and look at them and play with them. Most common, most popular is the candlestick chart, that one right there, which is what you're seeing on the screen now. Again, that's the most popular and the most common that most people trade with. But I like the candlesticks, but I like this little Fibonacci filter on them. So I turn that on, and watch what it does when I turn that on. This is the one last night I told you I was going to show you the cheat codes, right? This is one of my cheat codes. Watch this. Boom. You're going to be like, oh my gosh, I'm going to be rich, rich, rich beyond my wildest dreams. If you turn on that cheat code right there, that makes all the difference in the world of what happens in those markets. All right, let's turn it back off and see. That's what normal is. That's what most people see, but that's not what you're going to see because you're not normal people. All right, no longer normal people anymore. You're now part of a special club, and you know that you can turn on that little filter right there, and you can see a whole new world. That's just one cheat code that I like to turn on. So that's a cheat code, and there's other software programs that have started to put that cheat code in. So if you don't have Track and Trade, look around. You might be able to find that in your platform too. It's relatively new. It's not been around for forever. When I was at the Board of Trade Trading, they didn't have this little cheat code. Now they do. All right, this little cheat code is becoming more and more popular among trading platforms. But I'm going to show you some other cheat codes that nobody has, all right? No, not nobody, but some people have them, but not very many. You got to have a pretty high-end, pretty fancy trading platform to get some of these cheat codes. Now, I'm going to show you what they are, all right? So we're going to come in, and I'm going to show you right up here. See how on my button bar I have a little HA? You might not have that on yours. So what you do is you can modify it, and this little, see these little handles right up in here? You have these little button bars up here, and you can modify them and change them. Now we keep them really small because we want as much room on the chart as we can. Sometimes you have, I mean, have you seen Microsoft Excel and Microsoft Word and stuff? They have these great big giant button bars up there, and it takes up all your screen space. So if you got a smaller screen, you got this great big giant button bar up there, and you got this much room to work on down here at the bottom. You're trying to kind of figure out where those 3 lines of code are, or 3 lines that you wrote, because there's such a great big damn button bar up there. Well, we keep our button bar real tiny up there so it doesn't get in the way. A lot of people look at that and they say, hey, it's not very modern. You should be having those great big giant button bars like on Microsoft. And we say, no, different world. We want big screen for what we're working on here. Those little buttons up there can stay as small as we can possibly make them. All right, so they're up there, but they're small for a purpose so that we can have lots of room to work on the chart. Lots of screen space down here, okay? So one you can do is you can right-click on those little handles, though. See that little handle right there, just off to the left of that? And there's another one over here. Here's another little handle right there, and there's another one right there. See that little handle? Here's another one right here, a little handle. If you right-click on that little handle, it opens up another right-click menu, and you say customize that toolbar. And inside there, you got all the tools that belong on the toolbar, and you can come in and you can select them and you can put them in there. Now, you'll notice on my toolbars, I have some duplicates. Like you'll see the Fibonacci ruler here. You also see the Fibonacci ruler over here. Actually, you don't. What I have is I have a couple of duplicates in here. Oh, here's an arrow. Here's an arrow. The reason I do that is because I have it in multiple places because I don't want to have to go from here if I'm working on my chart all the way to Timbuktu to get to the arrow and then come back. If I got it in multiple places on my toolbar, I can just go up here and grab it and use it. I'll go over here and grab it. Depending on where I'm at working on my chart, I can go to closer locations to grab my different tools. And so that's why you'll see duplicates on mine. And so I do that on purpose, where I come in here and I grab those different tools and I just hit add and add them onto these little toolbars. All right. So that's why you do that. And then in here, you got the Fibonacci. So you slide down, you find HA, you'll find the Fibonacci, and you move it over from this side over to this side, and it shows, oh, that's now up here on this one. And that's how you can turn that Fibonacci on, and you don't have to come in here to the Preferences tab. So you can come in here, you can flip that, turn it on and off just by clicking it like that. And you can turn that on and off, because sometimes you might want to turn Heikin Ashi off to see what everybody else, the whole world, is seeing. And then like that big gap right there, see that? Ooh, that's ugly. But if you look at it with Heikin Ashi, that gap is gone. So you might want to know that that happened, big gap happened, but to us, this is more important. Okay. So now we've got that little secret code. Now I'm going to show you another little secret code. Let's come in here and I'm going to show you another little tool that I really love. And it's called the Bulls and Bears chart overlay. And we come in here, it's the Bulls and Bears. Now the Bulls and Bears is a special indicator that's designed to try and help us count the waves of the market and to also give us a neutral zone. Now we're not going to focus on it too much in this class, because we're going to focus on it more in another class, in an upcoming class. But you can see, and I'm going to show you another tool that we can use if you don't have the Bulls and Bears. So if you're using that free tool that we showed you in class called FinViz, it doesn't have Bulls and Bears. Most other tools don't have Bulls and Bears. This is proprietary just to track and trade. But what it does is it kind of counts these different drives. Now this is the S&P, and it's gone crazy. I mean, oh my gosh, look at this thing. This is the craziest market we've seen in forever, since last time Trump was president. All right. But what we're going to look in here is we're going to see the different drives. And generally speaking, we get 3 drives. Now, we got some little breaks in here and these little blue lights, and these little blue lights are going to help us with the drive. So technically speaking, we got 1 drive, a little 2 drive there, another drive, another drive, another drive, another drive, right? Till it kind of got up here, peaked out, broke a little bit, and then it made another drive and then another drive. But remember when I told you that each market has 1 up for every down? That's the ups and downs. All right, so let's come in here. And this market is not like the most exemplary market for what we generally traditionally have gotten. Elliott Wave patterns, this market just, again, has just blown all the doors off everything that anybody's ever done. So what's happening is we got 1 up for every down, though. So we got 1 up, you got 1 down, you got 1 up, you got 1 down, you got 1 up, you got 1 down, you got 1 up, you got 1 down. Now notice the trend. So we're getting higher highs and higher lows. So when you get higher highs, generally speaking, the trend is up. So you get long set of dots for the trend. And then this is called the counter trend. All right, the short set of dots. So remember, I told you we get 1 up for every down. We just don't know how big the ups and downs are going to be. So generally speaking, when you get a long set of dots, you're in a bullish market. We're going to get long the market, right? Long meaning that we're going to make money when the market goes up. And when do we do that? Well, when we get the counter trend. So the counter trend comes in here, and these are the short set of dots. So they're the down ones. And then that is the breaking for the next set of dots to go up. So down, up, down, up, down, up. So the downs are little, the ups are big. Downs are a bit little, ups are big. Once you start getting big downs and the ups are small, you've changed. You've gone probably through a head and shoulders pattern, and you're now going down, and you're making down patterns. But what we're seeing right now is that the market's getting to the point where it's not making big ups as it is. The downs are starting to become bigger. And so we're getting into more of a equal market where the downs and ups are kind of, when they kind of start getting to the same size, you're going through a neutral market or a sideways market. And then we generally get a reversal or a continuation of the uptrend. And it looks like to me, we might get a continuation of the uptrend. So that's how you read it. 1 up for every down. So you have little downs, and then those are your trigger points or your setup points. If you want to take a position long, that's a good place to get in to ride the next trend up. And then it's going to come down, and you have to decide whether you're going to get out or whether you're going to wait and get back in here and take your profits on those big long runs. But that's the little breaking points, those little breaking points in there. Okay. That's how you count. There's a mini 3 drive pattern. So there's drive 1, drive 2, drive 3. It broke. Then we got drive 1, drive 2, drive 3. It broke. Then we got drive 1, drive 2, drive 3. All right. So you're getting 3 drive patterns, 3 in a row. So there's drive 1, drive 2, drive 3. What does that mean? Well, it might not mean anything. But traditionally speaking, we generally get 3 drives, and then the market turns and comes back down a little bit. Now I want to show you another pattern. So if you come back over here and we pull up our little pattern, our book, there's another pattern in here that we talked about, right? Where we talked about one of the things is a triangle or wedge pattern. So these little triangles or wedge patterns are really super popular, triangles and wedges. And that was in our little drawing from last night in class. And you can see in here, we have lots of little triangles and wedges that we work off of. And here's a little wedge pattern right here. See this rising wedge? Now, oftentimes when you get a rising wedge, see how it's got drive 1, drive 2, drive 3 inside the little wedge? So that's in your manual. It's one of the patterns. So now you come and find that in the market. So we're going to come down here. And if you'll notice right here, I'm going to get rid of all this. Look at this little pattern right here. You got this little pattern where we come in here. We got drive 1. You got drive 1, drive 2. But actually right here, we got drive 1, drive 2. And then we got it's going into this third drive. So we got kind of this little three move pattern in here. It didn't break the blue lights on this one, but you can see it kind of went up, broke these blue lights, come back down, went yellow, went back up and made another one. So we have almost like 3 little drives, drive 1, drive 2, drive 3. And then the market flushed like a toilet, right? So if you come in here, what we do is we take our tools in the software and we draw a line from the low points to the high points. And you'll notice that it goes right along those blue lines. And then it also goes right along the areas of support along the bottom. Remember, we talked about support. So we got 1 support area, 2 support areas, 3 support areas, 4 support areas, and then it broke the support, right? Now, for us, this is way up high. As technical analysts, we look at this and we see that chart and we're like, wow, that thing is way up there. It's probably going to come down a little bit at some point. Now, we say that, but, you know, again, this is, we got things happening in this world that are just unprecedented. If I can use the unprecedented word, all right, if you know what I mean, all right? So we got unprecedented things happening in this world. Somebody's fiddling around trying to fix things, all right? I don't know who that might be, but somebody's making some waves in the world and they're fixing things, and so the market's going straight up. Something just unreal. So are we going to get that big pullback that was traditionally speaking? Maybe not, you know, we don't know. But traditionally speaking, we get a pullback. And so we use a measuring tool called the Fibonacci ruler. Now we can measure the different drives, and we can measure just from this low point to the high point, and we can say, how far are you going to come back? Well, come back, you can see it came back right down to what we call the Fibonacci sweet spot, or the delta cone of probability, where the market's going to come into a cone, and that's the cone right there. And let's pull up just for fun, we got to do this. We got to go look at our delta cone of probability, and I'm going to come over to our supplemental slides. And we're going to come down here. Come on, buddy, fill them all in. There we go. So the cone of probability is in our supplemental slides right here. So there's the delta cone of probability. Let's talk about this just for a second so you understand what's going on. This is what that's my name for it. If you go out and say, hey, Grok, tell me all about, or Chat GPT, tell me all about the delta cone of probability, it'll go, I don't know what you're talking about. It's actually, in the real world, it's called the 68, 95, 99.7 empirical data distribution rule. So if you want to go learn more about it and ask Grok about it, that's what you're going to have to ask Grok. What is the 68, 95, 99.7 empirical data distribution rule? That's too hard to say. I have a hard time saying that. And so I call it the delta cone of probability, because that is based on the delta of options trading. All right. So that's where it comes from. So I don't need to use that big word. I just use the word delta because it comes from options trading. We call it delta, and it's the delta cone of probability. Now, this is what the delta cone of probability is. If you've ever seen a standard deviation bell curve, I turned it on its side because markets go sideways. If you turn this upside right, well, that's how you're going to see it in most books and lessons that are teaching you about probabilities. So I turned it sideways just because markets trend sideways. They don't go up and down like this. They go sideways. So what we're doing is we're looking at the probability of the market rising or falling. So approximately 68.2% of the time, market data stays within one standard deviation of the mean. So if you look at the delta cone of probability, one standard deviation is right here. See this little one standard right here? Let me get myself out of the way so you can see, where do I need to go? Right here to get out of the way. Let's see. Okay, so see this one standard deviation. So if you were to draw a box around it, that would be your one standard deviation. Markets 68.2% of the time like to stay within that one standard deviation. Now, around 95.4% of the time, markets fall within two standard deviations, which is the little bit bigger box right out here. And then nearly 99.7% of the time, markets fall within three standard deviations. All right. 3 standard deviations. Now I kind of went through here and changed that wording a little bit. Let's look at it from this point. It says mean reversion suggests that asset prices have historically eventually returned to their mean or average price level. Tools for analyzing mean reversion. There's several tools that we use. One's called the Fibonacci ruler. It's the easiest one. Bollinger Bands. That's an indicator you can just lay over the top of the chart and it's on there all the time. Not my favorite, but it works pretty well in many occasions. And a lot of people like it. Another one is the RAF channel. That one's a little bit more it's kind of a neat tool because it's dynamic and it goes with the trend of the market. So we like Fibonacci ruler, we like the RAF channel. Bollinger Bands, I should probably put that in order. Fibonacci, RAF, Bollinger. So those are the tools that I like for calculating the mean reversion or the delta cone of probability. And then we come in here and one more way. I kind of change this around so you can think about it in a different way. Change your brain a little bit. Mean reversion suggests that asset prices have historically eventually returned to their mean or average. Let's apply this to trading. Entry points. Traders look for deviations from the mean, 1 standard deviation to 2 standard deviations, as a potential entry point for mean reversion trades. So we wait for the market to get way out into these really high probability locations of the market returning to the mean. Right? So that's called overbought and oversold. So if the market's way up here in the 3 standard deviations, it's considered way overbought and is going to have a high probability of coming back to the mean. Or if it's way down here in the low standard deviations, 2, 3 standard deviations way down here in the bottom, then that's way oversold. This is way overbought on top, way oversold on the bottom, and it's going to probably rise and come back to the standard deviation or the mean. All right. Risk management understands reversion zones, helps us set up stops, losses, and profit targets. So if we come and we leave the standard deviation by looking at what those standard deviations are, we can take profits at those levels as it hits those target levels because we know the likelihood of it going beyond the 3rd standard deviation is very low, and the same to the downside. We can start to buy as it starts to get down into that 2nd and 3rd standard deviation because the likelihood of going into a 4th standard deviation is so low. We want to be buyers way down there and have the market revert or return to the mean. So that's how we trade that. Option traders use mean reversion to write calls and puts at the center of the 1 standard deviation range, or what we call the VWAP. It's another tool that helps us, taking advantage, statistical advantage that price stays within the range approximately 68.2% of the time. So you can write your calls. For those of you who are trading with Granite shares, that's what they do, right? Or Yield Max, that's what they do. They're selling calls way out in the 2nd or 3rd standard deviation because the likelihood of the market going up there is very low. They get to collect the premium. Or Granite shares on the other side, they sell their puts way down in the 3 standard or the 2 standard deviation because the chance of the market going down there is very low and they get to keep the premium. So we use that in options trading very, very much. We also have indicators that are all based on this delta cone of probability and the standard deviation. So if I come in here, right click on the chart, say add indicator, and I come down to one of the most popular common indicators that there is called the MACD, you'll notice that the MACD is a representation of the delta cone of probability. All right. So if the market gets way up here, up in the top region, up in here, we're way up in that 1 or 2 standard deviations. If it comes way down here, we're way down in the lower 1 or 2 standard, 2 or 3 standard deviations. If it stays kind of right in the center, like here, well, now we're right within the standard deviation. All right. That's what that's telling you. Now there's another tool that we use, which is even a little bit more based on that same strategy. What did I just do? Turn off that was a mistake. Let's turn this off. All right, so there's another one. Let's come in here and add another indicator. This one here is called the stochastics indicator. Now, stochastics is even based on a 0 to 100 scale, so it's not even dynamic like the MACD. The MACD can just keep getting bigger and bigger and bigger as the market goes further and further and further. This one cannot. It's stuck on a 0 to 100 scale. So this one is a true standard deviation. So we even have the little 80-20 lines in here that show us anything above that is way outside of the standard deviation, and the market is probably going to retrace and come back down into the center. Or if it's way down here in the standard deviation, it's going to rally and come back up. So this is called your overbought region. This is your oversold region. Overbought's on the top side, overbought region, oversold on the bottom region, and that's your delta cone of probability. So you can watch that and you can see, and it'll tell you right here, hey, look, the market, I'm going to make this smaller so it kind of makes more sense. So we can bring this in, and let's zoom it in a little bit so we can see. And I zoom it up a little bit so we can make it big and so everybody can see. So you can see right here when the market goes through these trends, see how it rises and falls, rises and falls, rises and falls. As it's going up through that trend, it's going through the delta cone of probability. And so what's happening is you can see the market right here is way up in the very top of the delta cone of probability. And then it comes down and then it drops like that. And then it goes back up, tries to get above the delta cone of probability, can't do it, goes up, and then it gets a little bit higher, but the delta cone of probability is starting to fall. And this is an indication that we're losing strength. And so the market is getting ready to flush out and come back down. And that's what happened right here. All right. So then we're going to measure. All right. We're going to use our Fibonacci ruler, which is just another delta cone of probability. We're going to have our trend line in here, just like that. Let's simplify things. I'm going to come in here and, well, let's leave that on for now. So we got our area of support across the bottom. We got our area of resistance across the top. And so we got our little wedge pattern up in there. And so what we're going to do is we're going to look for the market to come back. And how far is it going to come back down? Well, we're going to anticipate, if we use the Fibonacci ruler from bottom to top, just like that, this is the delta cone of probability. Once again, this is the high probability location that the market's going to come back down in here. And in this case, it did. It came right back down, touched the very top of the delta cone of probability, or what we call a 38.2% retracement. Why do we call it 38.2? Why don't we just say 40, 50, 60? Well, it's a mathematical model. And so we use the numbers that come from these mathematical models. And, statistics, they use all kinds of exactness. And so it doesn't have to be exact. You can just kind of, we're not building we're not building skyscrapers here. If we're off by a couple of percentage points, it's okay. Markets aren't perfect, but they try. They try, and it depends on who's trading them. Lots of computers trade these. Remember, lots of computers trade these markets. The great big huge hedge funds, banks, and speculators, they trade with computers. And so computers have just been programmed to do the same thing over and over and over again, which makes almost easier, because it's somewhat easier to predict a market if it's just been programmed to do something. Once you understand how they program it and why they program it and what these delta cones of probability are, what these probability statements are that they were working off of, and you understand that, you're like, oh, well, they just programmed it in. So that's what it does. Now, there's always these guys out there screwing up the programs. That's the retail traders, because they don't use programs. Most of them don't know what the delta cone of probability is. Even if you threw it in their face, they wouldn't know, like a pie. They have no clue what half that stuff is. They're just out there gambling, right? And so they're the ones who kind of screw up these models. So when a model doesn't work just like you should, like, oh, well, it's going to come right back into the delta cone of probability, and it doesn't, well, it's usually because the stupid retail traders screwed it up. Okay. And so the computer systems from the big banks and hedge funds have to adapt to what the retail traders who don't know what they're doing are doing. So they have to adapt to it. So really the job of the big retail trade or the big banks and hedge funds is to take the money away from the retail traders. The big banks, hedge funds, they have all the money in the world. Think of BlackRock, trillions and trillions and trillions of dollars. They have all the money in the world. The only money they don't have is the money that you are trying to trade your account with. And they want that money too. So their whole system, their computer system, is designed to take money away from retail traders. That's what it is. So if you are going to be the traditional retail trader, and 80% of retail traders lose money for that reason, then you're going to probably just eventually be one of those people who loses money. So if you're going to trade and you're going to manage your own little hedge fund, which is what we talked about last night in class, right? What kind of trader are you going to be? Are you going to be a long haul trader where you're just going to throw money in there and leave it for 30 years? Well, a lot of guys don't have 30 years. We talked about that too, right? So you're going to have to be a little bit more aggressive. You're going to have to learn how to trade, and you have to take money out of the market, not just always put money in. And so you got to learn what these big banks and hedge funds are doing to take your money so that they don't take your money. And the biggest thing is that upside down pyramid thing. They just know for an surety that retail traders are going to build upside down pyramids, because they won't sell. They won't sell out when they make a bunch of money. They might do what's right. They might get in low and they buy up here, and then it falls back. They buy some more and they buy some more, but they won't sell at the top. They won't get out. They won't take their money off. So if it falls, well, because they build an upside down pyramid, the bank's going to take all your money. And that's how they do it. That's why these markets will flush like this. That's why we have these flushes back down, is because they know how to get you to sell your shares so that they can buy them. All right. That's what they're doing. And so we're going to come down here, and it's going to come back down into the delta cone of probability. Now, is it going to turn around and fall back down into the delta cone of probability again? Could. Nobody knows, right? Can make a little ABC pattern like this, go back up, and come back down. Nobody knows. Or it could just go up there and we're going through the Trump train. So you just have to take that into consideration, and it may take off and go again. And if that's the case, you got a little pattern in here where you can draw your little trend line. And if it breaks that little trend line, breaks those little blue lights, which is nothing more. Remember, the blue lights are nothing more than the mathematically calculated trend line. It tells you where to draw your trends, right? So up, down, one up for every down. And then you can see that we might just get one more nice big up, and away we go. Or it could, it could come up, come back down into this delta cone of probability. And that's how you trade. And so what we're going to do is we're going to look for these little reoccurring price patterns all along the way. So you can see these little points of entry. Here's another little a little triangle formation right there. See that one? So it comes up. We got lower highs and you got higher lows. Comes into a point, comes into a triangle. When it breaks out of that triangle right there, that would be a decision point or a buy point where you can get into the market. Now, if we turn off the bulls and bears, which has the yellow neutral zone, which is actually the delta cone of probability built into the price bar colors. That's what that is. That's why you have red on the bottom, you have yellow, and then green. It's, if you take a look, I'm going to delete all the drawing tools, come in here and draw it again. That's why we have red, yellow, and green. So you can see as the market goes through the trend, everything down here, this is below the delta cone of probability. Everything that's green is above the delta cone of probability. And if it's yellow, it's right dead center of the delta cone of probability. So that's what that bulls and bears indicator does. It calculates that delta cone of probability for you. All right. And then it puts these little blue lines in here to tell you where you got one up for every down. So you can turn that tool on. It's really a cool little tool, and it helps you a lot in trading to know where those points are. Or if you don't have it, you can just, learn to deal without it, and you come in, turn that off, and then you get to see it like this, which is fine. You can come in here and you can see, and it helps you, and it's nice to turn it off once in a while and see where these points are, right? But of course it would be going red, 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 and then go yellow in here, and that would tell you you're going through the Fibonacci cone of probability. All right, so that's how this works. So if you have that Fibonacci on, it makes it a lot easier and a lot cleaner and clearer on seeing that. If we turn Fibonacci off, you don't get those pretty pictures, all right, of where market's trending. So that's the name of the game. So generally speaking, what we like to say is the first green candle to make a new high can be a new entry point, and then of course the first red candle to make a new low, that's your exit point. So you can ride through there if you're going to be a short-term trader where you're going to take advantage of rising markets and get in and out, right? And then you can get back in right here and ride it up one more time. You never know how far it's going to come down. That's why you get out. But you can say, well, the probabilities say it's going to go up one more. So when you're in a Donald Trump train market, it has a tendency to just keep going up, 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 and away. Up, little down, up, little down, up, little down, up. Thank you. Little down. I got me some nice fresh tea. Ooh, that's hot. Okay. So that's how we're trading, right? We're looking for trading opportunities. And if you're going to do a longer term trade, well, we're going to build our pyramid, and we could just, right in here, you come in and you look at this nice little downtrend and then a downtrend like that. See the little patterns? And then you build your positions as the markets come down each time. And then that's how you get your big position for going up the next side. All right. So that's the name of the game. And is there a perfect way of doing it? No, there's never a perfect way to do it. That's why there's a market. There's a million of us traders, and so there's a million of us, a million different ways to trade the markets. But if you understand those basic underlying structures, then that's how you trade. So let's go look at some other charts. Let me show you one more cheat code. One more cheat code. So I showed you the bulls and bears. That's a really fun cheat code. You have to have track and trade to have the bulls and bears. There's some other tools in some other trading charts or platforms I've seen that kind of tried to copy bulls and bears, kind of similar. So you might find something out there that's a little bit similar. Remember, track and trade's been around for, almost 30 years. We were using this. This is software we were using at the Chicago Board of Trade when I was back there teaching. I was teaching off of track and trade. That's where it came from. All right. So it's been around forever. It's won Stocks and Commodities Annual Reader's Choice Award 7 times. But there are, and when you win an award like that many times, people start to copy you. I'm not going to go off on all the things that we invented, but we invented a lot of this stuff. All right, in this software program, and then they become industry standards over a while. So this is a platform, again, it's been around for a long time, very innovative, and so a lot of people have copied a lot of the tools in here. So a lot of the tools you see in here tools you see in other programs came from Track and Trade. Because a lot of these tools, when I started writing this software back in Chicago, remember, there weren't a lot of software programs. All they had was, I mean, when I started trading, we started on paper charts. Didn't even have computers, right? Computer charts. Our charts would come to us in the mail, and we would go look at the newspaper. You run down to Island Market, get the newspaper, and see what commodities had done, see what stocks had done, and that's how we would trade. And we'd have paper charts that would come to us in the mail. And so we started writing software programs, us and of course others, writing software programs. When software programs first came out, they didn't move like this. You couldn't move them on the screen. You couldn't draw on them. There were no drawing tools. We kind of came up with that idea of being able to draw on a chart. I came in and I said, look, everybody else out there has that's doing this. They've got charts, but you can't draw on them. And we want to draw on them because we were drawing on our paper charts. And I was like, we should have a computer. I want to combine a charting program like these other guys have, but I want to combine it with a drawing package like Microsoft Paint. At the time, it was Apple Paint, right? So we had Apple Paint and we had charting programs. So we'd get the data and then come in and create a chart. I said, I want to combine those two and turn a charting program into a drawing program so that we can actually draw on it and chart on it. And that's why everybody in the world has the ability to draw on their charts, because we started that. And then a lot of these tools are what we came up with, these little ideas of being able to draw, like a trend line or not just a trend line, because people jumped on that one real fast, started being able to do trend lines. And then we started doing all these other little tools like, let's make it so we can do a triangle. Let's do these little arcs and let's make all these other little tools. Let's do these little ABC patterns and let's do all these measuring tools and let's do everybody jumped on the crosshair too. That was a real fast one that everybody jumped on. I said, let's put the Fibonacci rulers on there. Let's do these halfway marker stuff, all this stuff. We came up with the ideas of putting all these little tools all over your chart. And then everybody jumped on and grabbed them and started doing it too. This little dollar calculator was something that we invented that came out of Track and Trade. So many of these things that you don't realize that we just use and take for granted and are on every software package. Somebody had to come up with those in the first place. And that was Track and Trade. That was us. That was my team. And we're the ones that came up with all this stuff clear back in the early days of the internet. All right, I got so many stories I could tell you when we first got the internet and brought it we had 56K. That's, how fast 56K is? That's really slow. But that was really fast back in the day. That was the first time we brought internet to our building, because everything else we'd dial in with modems, right? We'd dial in with a modem. In fact, that was my first business. I used to sell modems and network cards. I could see the writing on the wall. Modems are going to go away. So I sold that business off right at the right time, sold it at the high, got rid of that business. And I could see modems were going to go away and everybody was going to have network cards that were going to bring the internet right to your desktop. And so our first time we were one of the first people in Logan to get the internet to our workplace. And one of the first places that wired our business so the internet would actually go to our people's desks and they would have access to the internet from their computer without having to dial out to a modem. That's really cool, right? So yeah, I'm old. This is the world that we were in, and this is the world of discovery that we went through. And so all that stuff had to be invented and created, and all these tools and everything in the financial markets had to be created, invented. Somebody had to invent them. And a lot of this stuff that you see, again, that was my company that did it, because I was working out of the Chicago Board of Trade and I was learning all that stuff, and we needed software to do it. So we went back and we'd create the software for the traders at the Board of Trade. All right, so that's how this all came about, and that's why Track and Trade is such a famous in the futures industry. The stock market industry, they kind of picked up on all this stuff, of course, too, but we were the leaders in the futures industry for a long time. All right, so that's where this is from, and that's you'd be proud of having Track and Trade, because it was one of the innovations that ever come out in the first place. Okay, so let's come down and start looking at some of these other markets. All right, so we had a futures version long before we ever had a stocks version. So the futures version, like I said, that's kind of my history, and that's where I came from. I got a buddy coming in from Chicago, one of my friends from the Board of Trade when we were working back there. Traveled all over the country with him and his pal, Jake Bernstein. Those guys, we traveled all over the country, and we used to teach live seminars, right, all the time. We didn't have the internet that we would do all these seminars over. And so we were doing all the live seminars. We'd travel all over the country. And then, you know, what killed live big seminars? We'd go on one seminar. I had 1,000 people going to come and see us and then, you know what? 9/11 happened. Those buildings went down and those airplanes hit those buildings and people stopped traveling. And that's when GoToMeeting came out, and you could start doing meetings over the internet, and people could watch you play on your computer from their houses. And that was wow, that was neat. And that kind of killed the live seminars. There used to be live seminars all the time. Guys would be doing live seminars all over the country. Live seminars all over in Vegas and everywhere. You know, we don't do so much of that anymore. Now everybody's got Zoom. Zoom kind of took over GoToMeeting, became the more popular package. But now we do it all on YouTube. I remember when YouTube first came out, nobody wanted to go on it because, you know, it's like, don't put your stuff on YouTube. That's just where dorky people put their stuff. Right? So we avoided, you know, all at the Board of Trade and all of our lessons and classes and everything. We just had our own websites, and we'd put it up there, and you'd download it from our own websites. And we would avoid YouTube because the only thing that was on YouTube was dumb people. But the whole world changed, right? Now YouTube is, if you're not on YouTube, you don't exist. So we're all on YouTube now, out here trying to teach people what we do, show people what we do. It's just a lot of fun. That's why we do it. All right, so we come in here, and now we're going to go to a different market. Let's go down to Apple. We're going to go to Apple. And I've got Apple. I've got all the neat tools already turned on in Apple. And Apple, you can see, look at the drives, higher highs and higher lows. We kind of went through what we call the accumulation and distribution stage. Now, remember, we talked about that in class last night. I'm going to pull up my accumulation distribution model. Now, this is just a model. It's not perfect. It doesn't work like this every time, but you can, generally speaking, you can generally find the trend of the market going through this pattern. And it's really common. This is what's called the Richard Wyckoff accumulation distribution model. All right. And so he's the one who modeled this out because he was telling you, hey, this is what all the big traders do. This is what all the hedge funds and everybody does. And when I was in Chicago, I can confirm this is what they would teach these traders how to trade. This is what was taught. All right. So this is what you do. So we go through what we call the accumulation stage right down in here. See this? This is the accumulation stage in Apple. And then you can start to see it going up through the multi-drive pattern. So you got this, and you got these little wedges in here. See these little wedges in here? And then you got the topping pattern up in here where the market goes up, makes this little topping pattern, and then it turns around and comes back down the other side, just like that. And then it goes through another accumulation stage, and then we anticipate that this accumulation stage will be higher than this one, which was what makes the market be a bullish trend. If this accumulation stage comes down, and I have another model for that one, if you come and look at this one, this model comes down and the accumulation stage off is lower, comes all the way back down, almost matches the previous accumulation stage. And now this example shows you going up and breaking out to the upside, but oftentimes this will turn and go back down and break out to the downside, and you'll go into another downtrend, and that would be a bearish market, right? As opposed to a bullish market. So a bearish market, this accumulation stage would go down, and a bullish market, the accumulation goes up. So this comes down, you can see the lower part. But a bull market, which is what we're in now, has more of this pattern. So even though the market's coming down, we're still in a bullish market. We're just going to anticipate the blow off at the top, which is where they take all your money, right? I told you they take all your money because you're building upside down pyramids. So they build upside down pyramids. What they're doing is going through the big banks and hedge funds, the computer systems, they're buying down here. And then as the market goes up, who do you think they're selling to? They're selling to all the stupid retail traders who are buying all the way up. So retail traders buy, build an upside down pyramid, right? Big banks and hedge funds, they buy down here. They buy on the way down and down into this point here. They're buy. So they got a big upside right pyramid. And then when they run the market, they do this on purpose. They pop the market and they get all these retail traders to start to buy. And who's selling to them? They call it feeding the ducks. Guess who's the ducks? It's us, retail traders. We're the ducks. And so as this market comes up like this, goes through this trend, the big banks are selling to us. Sell. For every buyer, there's got to be a seller. And if all the retail traders, this market's going up like crazy, they're buying. Somebody's got to be selling to them. It's the big banks and hedge funds. because they're going to sell out, sell out, sell out. And what happens when the big banks and hedge funds run out of shares to sell? Well, they flush the market. Why do they do that? They get you to sell them their shares, your shares, so they can buy them, so they can do it again. That's the name of the game. And when you understand that that's the name of the game, you can play it. You can play the game. I always say trading is like a board game, right? It's a board game. You're all sitting around here. These are the dudes that you're trading against. All right. These guys are all trading, and you're sitting at the table with these boys here, and there's rules to the game. They got the stock market, the game, and they're all playing the game, and they know how to play the game. Do you know how to play the game? Do you know the rules of the game? That's who you're trading against. And so they're sitting there waiting for you to come in and start buy, so they can sell to you, build your upside down pyramid. Market falls and flushes, you lose all your money. They start buying it back as it comes back down, building their upside right pyramid. Now, as long as you know that's what's happening, you can trade it. If you want to buy, be wise about it and get out at the top, take profits along the way so that they don't flush you and take all of your money. All right. Because that's what they're going to do. That's the name of their game. So now that you know their secret game, which isn't that much of a secret, of course, most retail traders just ignore this altogether, don't pay attention to it. They don't go study. Remember, most retail traders are just gamblers, like we talked about last night. So if you can run it like a business, and we're going to talk more about how to structure your business in future classes, we're going to come in here and we're going to build ourselves this model, and we're going to work off of this model. Okay. And we're going to take profits along the way so that we don't end up with a huge upside down pyramid. So when this market flushes, we want to start accumulating when they start accumulating. We want to sell out when they sell out. We want to do what they do. Let's do what they do. Now, because we are small, we can't really do as much as they can do because they've got deeper pockets and they can play a deeper game. So we have to play a little shallower game. So we have to realize what's going on, and we can play these little moves in here. There's nothing wrong with buying here and selling out here, buying here, holding it on for the second run. But we need to count those because you can see how many runs there are. So this is the accumulation stage right in here. You can see that was the accumulation stage. We're going to come back in time. And this accumulation stage went way back here. See that? This was the Wyckoff spring down in here. You can see it coming down off the previous trend, went through the accumulation stage just like our model, and then they started running it back up through the Elliott wave, higher highs and higher lows. And this one really went a lot. Drive 1 had the counter trend in here. Drive 2 had the counter trend in here. Drive 3 had the counter trend. It had a little drive 4 at the top, which is really rare. We don't generally get 4 of these, but we are in the Trump train, so we have to take that into consideration. This market's going crazy. So we had that 4th little drive up there, but then we're getting the little ABC coming down off the backside. So we're getting the long set of dots, short set of dots to the downside, long set of dots again. Now, how far back are we coming back into the Delta Kona probability? We're going to go off this drive pattern right here at the beginning of the accumulation stage and measure it all the way from top to bottom, just like that. And where did we come right back down into? We came right back down into the Delta Kona probability. This is Apple. Yeah, I didn't cherry pick this. You know, who would have said Apple? You think I cherry picked Apple? No, it just did it. Just this right now. How much more perfect could that be? Perfect example of what we've been talking about of how this market works. And so now you're right back down here into the Delta Kona probability. So what are we going to start looking for? Well, we're going to start looking for that head and shoulders pattern, right? Remember we talked about that last night? Right now, this would be your head and shoulders, but I don't believe that's going to hold. Remember I said if it doesn't hold, you have to take it to the next level. I think this is going to be a little right shoulder in here, left shoulder. We might get another little head down in here, and then we have to adjust this to our right shoulder over here. I think it's going to go through another little accumulation stage. And accumulation stages are nasty. They're kind of ugly. So you can see this one. See how they're ugly? They have no structure to them. That's how you know it's an accumulation stage, because they run it up, and then all the retail traders buy, and then they flush it, get them to sell it so they can get them to sell out their shares. They want to flush everybody out and get as many shares as they can so that the big banks, they can accumulate as many shares as there are available to take. They want to build themselves a huge position before they run the market up so that they can sell out all the way up the uptrend, make a lot of money. All right. That's how they make money. So they buy all along here. It's get really ugly, but they don't buy it and run it. They need to accumulate over a long period of time. So they buy, sell, buy, sell, buy, sell, buy, sell. So what they do is it's called the accumulation stage because now this is a simplified version, but they'll buy 10 and they'll sell 9. They'll buy 10, sell 9. They'll buy 10, sell 9. So at the end, they've got a lot more holdings, but they don't run the market up. Because if they just started buying, buy, well, the market would take off and go to the moon, and they would build themselves an upside down pyramid. They don't want to do that. So what they do is they want to run the market sideways. So they don't want it to go up. So they buy a bunch, it runs up, and then they sell them. But they don't sell everything. So then they buy some more and then they sell them. But they don't sell everything. They buy some more and they sell them. They buy some more and they sell them. They buy some more and sell them. So by the time they get through the accumulation stage, they got a huge position, even though they've been buying and selling all the way through. They just accumulate. All right. That's how they can accumulate a lot of shares without running the market up. Pretty tricky, right? Tricky dicky. That's what they do. So now they've run the market up and they've exhausted everything they had. They've sold them all out. Okay. They sold all the way up the trend. Retail traders bought all the way up the trend. Now they run the market down to get you to sell out. They take your money. You lose all your money. They get you to, this is how they get you to sell it out. I'm going to hold on. I'm going to hold on. I'm going to hold on. How long are you going to hold on? Okay. Well, I'm going to keep running it down until you sell out, sell out. Come on, sell me your shares. No, I'm going to hold on. No, sell some more. Okay. Sell some. Okay. I'll sell some. I'll sell some. I'll sell some. And before long, you start screaming, Uncle, oh, I can't do it anymore. And so you sell all your shares to the big banks and hedge funds, and then they go through another accumulation stage right here, and then they drive that market back up over here. That's how it's going to work. You watch. Mark my words. All right. That's how it's going to work. Now we're going to come down and look at some other markets. Here's AMD. AMD. Nice, big, beautiful 3-drive trend. Look at that. Drive 1, counter trend. Drive 2, counter trend. Drive 3. Then it went through that shakeout stage. And then it's gone in again. And here we go. They run it again. There, we got another accumulation stage right in here. It went red, right? Remember, accumulation is the red zone on the bulls and bears. So they're accumulating shares right in here. They're accumulating. It went yellow, went through the neutral zone, then bam, took off like a rocket ship. And what did they do? They started selling to all the retail traders who were buying, building upside down pyramids. But they had all their shares through here. They bought, and then they sell. What do? You sell, and then you buy. That's why retail traders lose all their money and big banks make all their money, because big banks are buying here, and they're selling here. So what happens here? They flush the market back down. All the retail traders bail out because they lost all their money because they bought all the way up the trend, brought their dollar cost average up to the top, and then the retail traders start to sell out. Who starts buying? Banks and hedge funds. Buy, all down through here. They build themselves a big upside right pyramid. What's going on right now? Right now, you can see it happening. Right now. What's going on right here? They had this accumulation stage and they build up a whole bunch more shares of NVIDIA and now, or of AMD. And now what's going on right here? What's going on? Massive run. Who's buying? All the retail traders. Who's selling? All the big banks that bought all down in here. They're selling, taking profits along the way. Who's buying all those shares that they're retail traders so that they can build up another great big. Now, if the retail trader's smart enough to come up here and sell some out up here and take their profits along the way too, well, they can buy here and then sell here, buy here, sell here, buy here, sell here. If you're smart enough to do that. It's easier for me. I like to do this part. I like to just buy when they're buying down in this zone. And then when it goes up, let it run as far as I dare, and then start selling some off at the top. Okay. Do I know where the top's going to be? No, but I got pretty good guess because I got these little blue dots that tell me. So I can follow the little blue dots. I know when it crosses that blue dots, I better be out. Right. Or at least load it, unload some of it so that if it turns and starts to go back up again right here, at least I can start to get back in again. Okay. So that's how you play that game. But Lan, I don't want to do that. I just want to buy and hold. Okay, well, I want to buy and hold for 30 years. Okay, don't play this game then. This class is not for you. Just go buy and hold for 30 years. I'm teaching you how to trade, how the big banks and hedge funds trade so that you can do what they do. But if you don't want to do what they do because it's too hard, oh, I don't want to buy when the bars are red. I want to only buy when the bars are green. Okay, well, I can fix that problem for you. Come in here and go like this. I can come in here and say, when the bars are green, just change the color of the bars, right? Change the color of the bars. Now you know when to buy and sell. Just kidding. We don't want to do that. All right, we could come in and change the bars, and you'd know when to buy when it's green and sell when it's red. We can change it. All right, I like to use on this one. I like to use the progressive formula. All right, so those are my settings for the bulls and bears. If you want to use the bulls and bears, okay, let's go and let's save as my defaults. Update all charts. So all charts look like that. So let's come down and look at another one. You guys got one you want to look at? We can come down and look at. Here's Carvana. Carvana. It's doing really well. Look, the nice big accumulation stage. Buy. And then what do? Bam. Sell. You get another one. Sell. A little one here. Sell. Right? Look at Carvana go. All right. DIA. That's the Dow. That's that other index, right? Dow 30. Let's go look at gold. Look at gold. Holy smokeroos. That thing just keeps going like an Energizer bunny. But you can see the drives in there. Look at the drives. We come in here. You can see all your little drives in here. Okay. They go through the accumulation stage. Now, gold's going to act a little bit different because it's not quite the same as a regular stock. But nonetheless, you got your accumulation stages. Then you got a big rally. You got another sell-off accumulation stage, a big rally, another little sell-off. Now it's unbelievable. This thing is nuts, is it not? Yeah, it's nuts. Silver. Let's go look at silver because silver is doing the same thing. It's like out of control. Silver. Look at that. Everybody's been calling for $100 silver. They're calling for $100 silver back here during this accumulation stage. Right through here. They're saying it's going to $100. And sure enough, up it went. I was going to get into that, and I changed my mind and decided to put my money into Bitcoin because I thought Bitcoin would go up at a greater speed, and I was wrong on that choice. So I don't have any silver or gold in the stock market anyway. I have some physical, but I don't have any of this stuff. I have other stuff instead. But that's a beautiful market, is it not? Silver. Woo. Let's wait for a nice big reaccumulation stage, right? Let's wait for one of these. Wait for it to go through an accumulation stage, and then we can start to buy when it goes into the accumulation stage. When's it going to go into an accumulation stage, Lan? I have no idea. When it breaks that blue light. All right. So let's go through a couple others real quick, and then we'll let you go for the day. There's where's another NVIDIA. Everybody loves NVIDIA. It's part of the, and look at this big accumulation stage, right? I thought it might drop back a little bit farther. You can see that this thing went up. It's just too strong. One, drive two, drive three. So it got up into this accumulation stage. We had this little peak up in here where it pulled back down. And this thing's just been going through accumulation for a long time. This has been a long, wide accumulation. I thought we'd get a bigger pullback, but this market's just too strong. It's not going to pull back. People are not letting go of their shares. And so if you take the Fibonacci ruler and go like, where's the delta cone of probability? It came back to about 38.2 and it just stuck there. It's stuck right up in there. But I think we're going to get another big rally up out of this thing because it's not going to pull back. I don't think we're going to get it down into the delta cone. I think we got a new reaccumulation is what we call it. This is the reaccumulation stage, but it's been stuck in there for a while. Look how long it got up to the top of those three drives, and then it just stayed there for a long period of time. Because I've been doing a dividend version of this stock, I've been doing really well. It's been making good money all through here, but there's not been any growth. But I think we're going to get a growth spurt in here because now they've accumulated a lot of shares going through these red zones down in here. They've done this a couple of times. Drove it down once, went up, drove it down again. I think we're going to see NVIDIA move out of there, and I think it's going to move higher. I don't think it's going to move down into the cone. I think this is a reaccumulation stage, and I think we're going to see it go higher. So I've been buying through here, buying, accumulating along with the big banks, and I'm waiting for the rally out. Okay, so there's that one. What's another? Palantir is another really popular stock, right? Really popular stock. So we're going to come in here. Let's delete all this stuff. And that's what this one's been doing. It's just been going straight up too. But you can see all the little multi-drive patterns. Clear back here in the back. You see drive 1, drive 2, drive 3, and then it made this massive drive 4, and then it finally got an accumulation stage. So we got a little accumulation stage in here, and then it took off like a rocket ship. Man, up out of that thing. And then it finally came back down, come flushing back down into another accumulation stage, and we were able to buy some more shares here. And then up it went, come down into the delta cone of probability, and then finally it took, look at how long it took, all the way from March clear until September before it came back down into an accumulation stage. This market's just been crazy nuts. And now it went up again, and now it got a big accumulation, big drawdown in here, and then it rallied back up. Now we're getting another one here. Now, these two lines here, this is the 100 period moving average, this is the 200 period moving average. These are very important numbers because everybody uses them. This is a Me Too market. You know, it's kind of like self-fulfilling prophecy. Markets do things because everybody knows that everybody does things. So if this market, I'm waiting for it, I'd love to see it come back, bring this accumulation stage, this red bars, all the way back down into this 200 period moving average. I don't want to see it come down and go bearish, and that's kind of what it's looking at right now. If we do a little projection down the Fibonacci scale, or if we do a Fibonacci ruler all the way from maybe the bottom here, see that Fibonacci delta cone of probability is clear down here. I don't want to see that, but you know, I wouldn't. I've got some of this and I'm hanging on to it. I don't want to see it go that far back, but we had this whole little drive back here. So let's go back a little bit further. So let's go off that last 3 drive pattern right there to here. See how it came right back down into the delta cone of probability right there, right down into the Fibonacci sweet spot. You could even do it even a little shorter one here. Go back, let's take this one back to here. And then you see from this low to this high, it came back, it pulled back, it didn't even make it down into 38.2. Didn't come all the way back down into the 1 standard deviation. So then it went up here, and then it did. It kind of went back into the 1 standard deviation back here, and then it took off and went out again. So then you start over. Now you can measure each one of these little, what we'll do is we like to measure each one of these little runs with the Fibonacci ruler. So each one, we'll measure each little drive and see how far back it comes into the delta cone. See that little drive right there from low to high came right back into the neutral zone, into the delta cone of probability. And then this one we measure here, and it came right back down into the delta cone of probability. So you want to measure each one of these little drives, and when it comes back down into that 38, 50, 61.8% level, that's where you want to be a buyer. That's where you want to start buying up, all right? And then when it starts going up, you want to sell out going up. You don't want to buy going up. You want to sell out going up. Now we're going the other way. We're getting lower highs and lower lows, aren't we? Okay, so no longer higher highs and higher lows. And now we're getting kind of a little pattern like this, a little wedge pattern off the top, and it broke out the bottom. And we're getting another one like that, a little extended one into a triangle formation. So we're going to have to wait and see what happens. But this 200 right here, and this is the real key point, because if it stays above that, it's not going to make, it's no longer making lower highs and lower lows. It's now making higher highs. See, this is a higher low. So we're kind of coming into this little wedge pattern. This is a decision point that we're going to have to wait and see what happens. It wouldn't be bad if it came down. I would like to see it come down underneath the 200 period moving average, maybe off of this entire thing. If we go from this low here all the way to the top, at least down to maybe 38.2. See if it could come down and break that right there. I wouldn't feel sad. That would be nice. And then we could start to buy, be strong buyers down in here. I've got money sitting on the sidelines waiting for this market to fall down here a little bit so I can start accumulating. I got about $100,000 set aside for this market because I really believe in Palantir. I believe it's a great stock. It's a lot of people are in this market. The fair value is way out of control if you look at the fair value, but I think it's a great stock, and I'm looking for an opportunity to add to my position. So I lightened my load. I don't have as much, plus I put a hedge on. And so if it comes down, and then I want to see it go to the moon again. So that's when I'm watching. All right, guys, I've run out of time, and so we're going to let you go. But that's how you do your technical analysis. You read charts. That's how you read charts, and that's how we make our trades, and that's how we make our trading decisions. And whether you're using options or whether you're using shares or whether you're trading off of dividends, this is how you do it. This is how you run the growth side of your investing strategy. All right. Okay. If you have any questions, let me know. And I'm going to come in here, and I got one little thing I want to show you. If you have questions and you want my help, I'm happy to work with you. You can book an appointment with me. Just take your little phone scanner and scan that code right there. Sign up, and I'll be happy to work with you. And if you need me to help you set up your software and set up your charts so they look like mine and show you all the cheat codes, I can do that. And that's all I got for you today. So I'm going to let you go. And we will catch you, let's see, Monday night. We've got class coming in Monday night. And so you can, we'll talk live again Monday night. All right. So how do I get that off of the screen? Trying to get that off the screen. I guess it doesn't come off the screen. All right, guys, we'll see you Monday night live at the university, and then we'll have another lab here probably Tuesday morning after the class on Monday.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.